He's off. Yeah.
Yes guys, welcome back to a whole new video on the channel, and I had to make this video a little bit earlier as I'm flying Vegas early in the morning. As soon as we trade the AM session tomorrow, which is Friday, we're flying out to Vegas. You know, I need to catch that next flight. So I've made a quick breakdown example explaining what the unicorn model is, and a similar trade example, well, a model which I've made up here of what actually happened today, which was Thursday the 25th of July. I've also created a quick fact sheet which is very important for you to follow by in order to be profitable with trading ICT concepts. So this is one rule that is very, very, very important when you're trading. Do not take more than 1 to 2 trades a day. I cannot stress it enough. I see people jumping into the London session, the New York AM, the New York lunch. I see them jumping into the afternoon, and then they dive into the Asian session. Like, how many times do you want to dive in? You only jump into the market maximum 2 times in one trading day. Why is that? So what point would you end up taking 2 trades in one day? So if you took that first trade, say you traded the AM session and you took a loss, no problem. Then that means it gives you the ticket not to take a stupid trade, not to trade inside of that macro which you took a loss in. You skip that macro and say you wait until the next AM macro, which is from 10:45 to 11:15 AM. Then you look in that macro with half position size. If you take a loss, you half down from, say you're on 8 contracts, you half down to 4 contracts. So you go with half position size and taking a look at the next macro to see if you can find an A+ setup inside of that macro with half position size. If you do not find a trade throughout that whole trading session, or even the next day you don't even find a trade, then nothing to satisfy what you're looking for, and you remain at half position size, doesn't matter if it's the next day or the next week, you stay at half position size until you catch a winning trade. Then you can go back to full position size. That's the correct risk management for your accounts. And then also, this is very, very important to note. This is a simple bullet point answer to what the unicorn model setup is. Anytime a significant price moves lower, it is expected to always anticipate some measure of a stop hunt on buy stops or a short-term high being taken out. What does that mean? So when price comes up to buy side liquidity here, and the first original sweep of buy side liquidity, which is this, you would look for this, anticipate a short-term high being taken out. Here you go. So the short-term high, which originally took out buy side liquidity, you look for it to get taken out. When price has now taken out this short-term high, you would anticipate a displacement which will be below the previous swing low which it created before it took out that previous swing high. What rests above here? Buy stops. So price has come up, it's taken buy stops, and then if it has generated enough liquidity and it is the right time and it's just before the macro, then you would anticipate and see a fat displacement. What I mean by fat displacement, this is what you see: a very sharp move in particular direction after taking out a short-term high, being in a premium of taking buy-side liquidity. This is what you like to see inside of the macro, is a clear displacement. So for this example, you can see that price did not displace the first time, which is okay. You sit there waiting patiently to see what price has to offer. Then price came up again and took out a previous short-term high, sweeping liquidity and taking buy stops for the second time, which makes the move even stronger if it was to displace. Then at this point, you would anticipate a displacement lower, as now you've entered inside of the 9:45 AM macro. Firstly, this is a brief example which I've marked up for you guys to see, and I am about to get into a full trade breakdown of the trade we took today, which was Thursday the 25th of July. So now price has displaced lower. You can see here it's displaced lower inside of the macro, and it left behind a bearish fair value gap and a breaker block, and it displaced, or call it market structure shift, in the opposing direction. So now you can clearly say that you would take this as soon as price comes up and taps the bearish fair value gap. You don't want to enter anywhere else. You don't want to enter on the midpoint of the fair value gap. As soon as price comes even close, market order straight away. Don't use limits. We don't use limits. You can if you want. Personally, I like to use market orders. I get a better feel and a better feel for price using market orders. I don't like using limits. So you'd market order as soon as it taps the bearish fair value gap. You'd run your stop just below the highs. There's no point running at the highs. ICT says to run it above the highs. This is obviously not a valid example. Obviously the example which I've marked out here is not valid. It's saying it's a 98 handle stop. Obviously I'm just showing you guys just a quick example. I will show you a live example of what we took today. I took it live on the channel, so you guys can go check it out. Onto my channel, click live, and I took this trade live. You'd run your stop just below the previous swing high, which was the high of the unicorn model, just below it. Around your stop should not be greater than 25 handles. So usually unicorn model setup will give you around a maximum of a 17 to 20 handles stop. If you have to run a 25 handle stop, most likely probably not the right trade. Today we ran, I believe, around a 22 or 23 handles stop. It wasn't quite 25 handles because 22, 23 was a valid point to put our stop. Then first TP you'd run at 25 handles, second TP at around 50. In this case, in the trade we took today, we ran it at around 68 handles, which was a previous swing low. So this point here would be a valid point to put a second TP, as it is a pair of equal lows. You can see here we got equal lows. You'd run your second TP at this level, first TP at 25 handles, and final TP at the opposing liquidity. Let's just say, for example, this is London lows. Let's just say that for this example. Final TP at London lows. I hope I've managed to explain this to you guys in the clearest way possible. We had that first sweep of buy-side liquidity. Price came up, took it out, did not displace. Price then created this previous swing high, came up, took it out again, took more buy stops, displaced. Inside of the macro. Left behind a bearish fair value gap. Price came up, tapped it, came into it. We already entered short, stop just below the high of the uni, first TP, second TP, final TP. And that is the trade example, and ICT pretty much explained in about 2 to 3 minutes. You'd have to watch 41 episodes of the 2022 mentorship, and God knows what else is on YouTube. The amount of names and different strategies which have been created over the past few years about ICT. There's new names coming out every single day. And you don't even need to pay attention to any of it. Once you find your model, you have your model. You don't give a shit about anything else. It really does not matter at all. Once you find your model, you don't have to watch another video again. Now let's get straight into the full trade breakdown of the trade we took today. Right, getting into the trade breakdown we took today on Thursday. So first of all, starting on the 15-minute time frame, like we always do, we're going to mark out the key buy side and sell side liquidity, the major lows and highs. So we got some clean London lows here. We're going to mark out this as a key buy side liquidity. We'll also mark out this as buy side liquidity. Why this? Because at 8:30 we had high impact news. So this would be the high impact news low which it created, and also this previous high which has not yet been taken out. So now we've marked out the key levels on the 15-minute time frame. We're going to head over to the weekly time frame because I want to show you something that I have seen. So going into this session, I seen that we had taken out this previous swing high and we have a bearish unicorn on the weekly time frame. So that's leading us more to a bearish bias going over the next few weeks. Dropping down to the daily time frame, we also have a daily uni model. So the drawn liquidity as of now is going to be 18,488. And this level here, which is 17,339. So the drawn liquidity at the moment is 100% lower. If this weekly bullish gap gets completely inversed and it turns to an I fair value gap, then we can happily say that price is going to reprice lower. And even on the monthly is not looking good as well. So this bullish gap's been completely engulfed. And it looks like price wants to reprice lower and take sell side at 17,333. Anyways, so even though we're going into this session with a higher time frame bearish bias, you can still see that price is in a major discount. But because price is in a major discount, but we have a higher time frame bearish bias, that leads me to have a neutral bias. So this morning, on the 15-minute time frame, you can see that we have taken out this previous swing low and we have displaced higher and tapped into this 15-minute bullish gap. This is my original approach inside of the live stream. I was most likely looking for longs today, and then I headed over to the 5-minute time frame, and let's fast forward price to see how it reacts. Right. So prior to the macro, I want you to take a look at price on the 5-minute time frame And now take a look at it on the 15-minute time frame. So what you can see here is that on the 15-minute time frame, a lot of people would see this as a higher time frame displacement and a retrace into this bullish gap. On the 5-minute time frame, obviously you want to fade the lower time frame for the higher time frame, but at the same time, if the 5-minute time frame has taken out that previous swing high, just as I showed to you guys earlier, so this is a buy side liquidity which has been taken out here. So buy side has been swept. So the original sweep of buy side got taken out. It then displaced lower but didn't create a bearish gap on the 5-minute time frame. Price then came up again, took out that previous swing high and also swept more buy side liquidity. Then after taking this level of liquidity and also sweeping that previous swing high, we've seen a fat displacement lower on the 5-minute time frame prior to the macro. So that instantly led me to think that we had a bearish bias going into this session, and the drawn liquidity at this point would be London lows. So dropping down to the 1-minute time frame, we are now going to monitor price as we come up towards the macro. So at this point, prior to the macro, I was looking at price that we had taken out this previous swing low, and I marked this originally as minor sell side liquidity, and that this short-term low had been taken out, and I was anticipating a displacement higher to see if we got a bullish unicorn to go long, and then to see also with that 15-minute bullish gap to see if price would then snap back up and respect the 15-minute bullish, so then we can take longs. And as you can see here, price did end up displacing higher. So I actually marked this bullish gap out as a valid displacement higher and waited for the macro to see how it would actually respect. You see this 5-minute bearish gap? I wanted to see how it respected it. Whether it would tap into it and look like price was going to run through it, or whether it would tap into it and algorithmically respect it and draw back down. So prior to the macro, you can see 1 minute prior to the macro, price actually inversed this bullish fair value gap. So price closed below this bullish fair value gap, therefore invalidating it. And I actually deleted all of this off my chart, moved the uni to the previous swing high. So price took out this previous swing high, tapped the 5-minute bearish gap. And also on the 15-minute time frame at this point, price had also inversed that bullish fair value gap as well. So now I was waiting to see if we got a displacement lower of this previous swing low which it created. So I was waiting for a displacement. And now we're also inside of the macros, so let's bear that in mind as well. There you go. So it's very, very small displacement, but you can see this previous swing low and this previous swing low had then been broken. So that's a shift in market structure. And we had this 2 minute. So it's not very clear for some of you. You would be looking at the 1 minute time frame and thinking, okay, we have this 1 minute bearish at the top. I wasn't looking to enter off that at all. I actually marked out this bullish gap as an I fair value gap. So I was like, okay, it would be good to see if price came up to this inverse bullish fair value gap. However, we had this 2 minute. So the first fair value gap you find after a displacement, the first one, as long as you can run a valid stop, you take it. So we've seen this 2 minute bearish gap here, and we entered as soon as it came off a tap. We ran our stops around 22.75 handles, around 23 handles, just above that bearish I fair value gap. Our first TP was around this level here for around 30 handles. Our second TP was at around 64.5 handles, and the opposing liquidity for this trade was obviously London lows, which was around 82.5 handles for us. So now price has come up inside of the macro and tapped this bearish 2 minute gap. We entered short, and now let's see how this trade plays out. I'm just going to pause it quickly. Look how many times it tapped into that bearish gap. So it gave you 1 entry, 2, 3. It gave you 3 entries to go short. So a lot of people managed to take this trade. It's not like it just tapped it once and it went. Sometimes it does that. It gave you 3 times to enter short. And also ICT does talk about the 3 sweeps of liquidity. So look, price came up, wicked back down. Price came up, wicked back down. It's just price gaining and gathering more liquidity. And now, as we go all the way to final TP, notice how many green candles there are on the way down and how algorithmically, since the last point of entry, how algorithmically price reprices lower all the way to London lows and past London lows. And there you go. It's gone off my screen. But just look how algorithmic price is. Only one small green candle all the way to London lows. And just like that, we secured 83 handles on that trade. It's a very, very clean setup. Some people struggle to find it and see it. I seen that clear as day. It was an extremely clean setup indeed. It was a very nice setup. I seen it. And we took that inside of the group and everyone caught 83 handles. If you actually want to see me take this trade live, head to my YouTube channel, click the live and scroll down and you'll see it. I post all of my live streams, which I trade live every single day inside the signals room for our members. Of course, everyone takes this trade. And a lot of you watching this video, you took the trade with me. Congrats. Easy gains. More trades coming like this. The winter months are coming back, of course. And I hope you guys enjoyed this video. I'm dropping an absolute banging vlog. It's coming out soon. So I'll drop a link for the second YouTube channel. Hopefully we don't get banned and demonetized. There's two sides of me. You got the trading side and then you got the absolute loose side. And that's for the second channel. Let me know what you guys want to see inside of the next video and I will note it down and make sure it's in the next video for you. Let's get 200 likes on this video and subscribe to the channel and I will see you in the next one.
I just did my 39, gotta change my sheets. Shit be rubbing on my body, sucking till my knees get weak.